say make money, money, make money, money, money.
Make money, money, make money, money, money. Money makes the world go round. I'm the talk around town.
Welcome in to Just the Tips, your favorite financial podcast. I have with me Brucey Boy and George. He's now named himself here George Rohr, so the Lion. How are you guys doing?
I'm the Bear.
Oh,
And this is my favorite financial podcast, just to confirm.
Yes. By the way, it's not a podcast where we give advice. This is not investing advice. Investing has risk. You can lose your money. Do your own homework. Consult a financial advisor. Past results are not indicative of future results. Some stuff like that. And let's get it on. So,
although our past results have been pretty good.
Yeah, that's true. Thank you for that commercial break.
But don't follow the advice.
Don't do it. Or do so at your own risk. Use protection. Some puts is what I'm talking about. So,
by the way, I noticed our podcast has an E next to it, and Bruce and I were texting with a former colleague of ours, and he made a good point. E is for excellent, I think, next to the podcast.
Yeah, not everybody. Right? It's not everybody. I don't know though. My 5-year-old likes it, but he doesn't speak a lot of English, so it's all good. So let's move on.
Muy bien.
Yeah, muy bien. So let's move on and do our quick, do a little quickie, a little news quickie. I'm always down for a quickie. Let's talk about markets in general. Oh yeah. Oh man, that was titillating. Thank you. News break. So George, what do you think, man? Markets anticipating rate cuts. What's happening? Tell us what's happening in the big picture. What do you think?
Yeah, I mean, you still got Trump pushing for rate cuts. You've got, Powell holding back, but I think you got some soft CPI numbers. Employment looks a little shaky. We didn't quite get a strong employment report. And so I think there is a story to be said for like rate cuts could or should happen. The market's starting to bet on that. The one thing where you saw inflation was the PPI, the producer index. That was actually much higher. So I think, Powell has ground to stand on. But like end of the day, when I think about it, it's like, I kind of get Trump's point. Like end of the day, like if there's tariff inflation, like it's due to tariffs. It's not due to other underlying factors. It's kind of a one-time thing. It'll hit the market but like the difference really is like are you spurring inflation, through other means? And I think the answer is no. And so, is a rate cut good for that bottom half that's not doing as well, where employment gains are not happening? Like I think we could see a rate cut, but we'll see how stubborn Powell is. I don't know. What do you guys think?
I think Trump is going to troll his way to a rate cut. I think there's only enough time and energy that JP can spend defending not doing a rate cut. And PPI was really hot actually, but I think CPI came in just a little bit under where people thought it was going to land. So I just think
CPI was 0.2 month over month, and then
consumer price index for those not of that's
PPI was 0.9, so it was significantly over the 0.2 that was expected.
Yeah, I do think though, I don't know how you guys feel about this. To me, it feels like the market just wants to rip. Like it's looking for a rate cut or even a hint of a rate cut. It may already have been priced in because we've seen like a lot of I think we'll see more and more volatility, but it does feel like the market is so long biased right now that it's ready to completely.
There were a few earnings
to the next level.
Like the IPOs have been hot, right? So like the bullish IPO was insane. If you looked at that, I think it was up over 80%. At one point during the day, it was up 150%. So there's just a ton of enthusiasm.
All of the IPOs have been super hot.
Yeah,
like Circle, CoreWeave, Bullet, like everything. The Reddit. I mean, if you go back, all of the IPOs, like the recent IPOs, Rubrik have all been very, very hot issues. Like the market is desperate for new company issuance, and like, I mean,
Desperate for growth, right?
yeah. And so I don't know. I mean, I think the market is like, there's definitely the haves and the have-nots. Like if you look at the S&P 500, it's obviously like a market cap weighted index, and so the Mag 7 has generally like been responsible for a lot of the gains that the S&P has seen, and the rest of the S&P is sort of flattish, I would say. So there's the S&P 7 and there's the S&P 493 kind of thing, and like there's a clear divide, but the 7 are so big and they have so much momentum that like I don't know if anything can stop them in the near term.
Yeah, the market's never seen this kind of concentration, right, in 7 names, right? The amount that they're driving the stock market, which is amazing. So
It's been that way for years right now, right? Like it's been that for a couple of years.
But it keeps getting worse.
It's the most Pollyanna market I've ever seen in my life. Like no matter what Trump does, he could walk into Times Square and shoot Jerome Powell, and this thing would instantly probably go up. Actually, it definitely would go up. But I think, it's just it boggles the mind. I mean, CoreWeave didn't do so hot though, right? In their earnings, so we have some.
Yeah.
AI gold rush is, maybe.
I think the thing is though, the read through on CoreWeave though. I mean, there was a couple of events they reported earnings, and I think the street was looking for more. Which I'll come back to in a second. And the other piece was their lockup expired on Friday for some of the shareholders, and so like there's always going to be a massive amount of selling pressure on lockup expiration, and so you saw the stock have kind of the double whammy here of both softer earnings than street expected and also the lockup expiration. But if if the read through that we heard from the management team was they're really just supply constrained. Like their view was like there's infinite-ish demand in the market, and the only thing that's limiting their numbers is like GPUs and space and data center capacity. So, I mean, if you believe the management team, it's kind of like just a minor blip in the road, right? Like this is something like that isn't pointing to like broader macro concerns around like where the AI market is going or demand in the AI market. It's more just like, can they get enough space and GPUs to sell to the amount of companies that want to buy them?
And I love a technical dip and a non-fundamental driven sell-off. Like to me, that's an opportunity, and AI is on fire. And I've always said CoreWeave doesn't have an obvious sustainable competitive advantage, but for now, they're NVIDIA is giving them an allocation and has an investment, if I remember right. So buy the dip. That's what I say.
Well, they're just not cheap, right?
They're just not cheap.
Expectations have gotten so high.
Are you talking about valuation right now? Is that like the market gives a shit about valuation? Okay, I got it.
Look at Circle, right? After we covered Circle, so Circle reported too. They were 53% year over year, beat expectations. They went down as well.
They're crypto and interest rates, basically, right?
Yeah, exactly.
So,
like an interest rate cut really hurts Circle. So maybe.
IPO, crypto is on fire, right? Like crypto, AI, buy.
Yeah, but they're also, they're paying more for distribution costs than, like, their distribution costs are growing faster than their revenue, and then you look at the valuation, it's like 13 times revenue and 130 PE, and they're a profitable company, so you can use a PE multiple on them. Granted, they are investing a lot, but, those numbers are not for the meek, so, you have to be perfection to continue that kind of valuation. So I think it's just many of these are priced at perfection already is the hard part.
That's fair. Any other topic? I would briefly touch on very briefly Buffett buying the United stock there. I mean, that's just, I don't know. It's not tech, but it's always interesting to see what Buffett's doing. I don't know. He's always a very long-term play, and I don't know. It's interesting. Shoot your CEO, stock goes down, Warren swoops in.
They've had a lot of problems, right? I mean, that's a big name stock that's down like 50%, right? Since they've kind of had those problems. It's probably not even Buffett at this point, right? He's retiring soon, so it's all his lieutenants.
Well, Berkshire has really hit a big speed bump here, right? Ever since they announced their retirement, the stock is off like considerably. I want to say like 20 or 25%.
So don't bet on a loser like those guys. Don't chase that. Is what you guys are saying. All right, let's just wrap this up. Let's get right into the main event. Who's the bull on this thing? It's Brucey, right?
I'm the ball here. Yeah, hold on.
Yeah, and then
Bruce is pumping his PA basically.
Yeah.
So,
yeah. So
We'll make the disclaimer before we talk about it that I do own this in my PA.
It's kind of strange how Bruce always wants to talk the book and promote, but anyway, that's okay.
I'm gonna tear him down. Don't worry about it.
Yeah, I'm not worried about it. I just worry about the number of slides that you have. And I might be bored to death by your like ratios of incremental SGA growth per week or whatever. Like it's just like, dear God.
I got the 17-point plan to bring it down. Don't worry.
Yeah, all right. It's all right. We like this is a more undercut, an unknown gem, right, Bruce? This is
yeah.
a hidden gem.
Maybe like the title of my slide. Hopefully you guys can see it. Is
Oh no, we have the same title.
For real?
Yeah, no lie. It is more of a bull title than a bear title, but it felt like it fit.
Is the stress on a different word, maybe? You're on the.
I think I put a little like different. Well, anyways, you'll see.
I'm sure it's less.
Well, the one kind of read through there is that our listeners now know that we don't see each other's presentations before we show them on the pod.
That's integrity, baby. This pod, no coordination behind the scenes.
Yeah, we're not corroborating behind the scenes here. Anyway, the title for those that missed it is Wild and Out. Like the ticker for the company is WLDN. Company's called Willdan. And the title for the presentation is Well and Out. So a throwback to the Nick Cannon era on MTV.
I keep thinking about Walden Pond and like Taylor David Thoreau for some reason, 7th grade, But by the way, everyone should know that the slides are available on YouTube. We do have a decent chunk of folks going on there. So if you really want to, see what we're talking about, please refer to YouTube. Proceed, Bruce.
Yeah. So, as Gordo was saying, this is really kind of a hidden gem. This is a smaller kind of market cap company that's really seen some significant tailwinds from AI. And it's one of those companies where, we talk a lot about, companies that are selling technology, companies that are building large language models like Amazon or Microsoft in some ways, although they're mostly partnering with other folks, but certainly Facebook and Google. This is really a company, and there's been a lot of companies around this ecosystem that's building the picks and shovels or creating the picks and shovels for this, transformation in the AI industry. And that type of tailwind has obviously helped a lot of different companies in a lot of different parts of this kind of broader AI ecosystem. And this is a company that, is a little bit different than most of the companies we've covered, because they're more of a services company than a software company, although they do have some software products. So it is one of those things where there's obviously going to be direct beneficiaries from any transformation in technology, and we've seen the private markets really rip here with a lot of different companies that have gotten supersized valuations in probably the shortest amount of time we've ever seen. We've seen companies get to scale from a revenue standpoint faster than any other companies in any other markets that we've ever seen. And then kind of around the edges, there's a whole host of companies that are going to be beneficiaries, from such a massive transformation. One of the kind of direct beneficiaries is obviously, the energy space itself. One of the constraints for large-scale AI and large-scale language models is, do you have enough energy to power all these GPUs? And so a company like Willdan actually does help in that regard. So kicking over to the first slide and just trying to make this as streamlined as possible. But just some fast facts. So, this is a company that was founded in 1964. So, it's probably 40 years older, 50 years older than the average company we've covered.
But before we continue, is this on full screen mode? Like, I'm seeing everything. Are you seeing all of that,
it looks
George?
a little. It's hard to see.
Yeah, can you go to full screen? This is really, there we go.
There we go. Yeah.
You're a grower, not a shower. All right.
The only problem is I can't see you guys then, but it's okay. Okay.
Staring in my eyes later. I'll give you the eye
I'm
contact
frowning the
you
whole
like.
time.
I'm licking my lips.
Okay, so it's a smaller cap company, so it's a $1.6 billion company in equity value and a $1.7 billion company in enterprise value. They have about 1,800 employees, and the CEO has been at the company almost 10 years. A guy named Mike Beaver. He was previously the head of their
Justin
corp dev group.
Bieber's father.
So, Bruce, I just have a question.
No relation to Justin Bieber, I don't think.
Bruce, I just have to ask, are you a believer? That's it.
I am a believer, dude. I think that Yukon song is it's fire, as the kids say. But getting back on track here, so the company, founded a long time ago, smaller cap name, what they do is really build a lot of the grid planning software, policy advisory, data analytics for governments and for utilities, and they do a lot of the program management for these utilities and lead some of their cost savings and energy saving efforts. So, for example, if you're Con Edison and you're trying to sell a new energy service to small and medium-sized businesses, there's a lot that goes into that, right? Like, how do you set up the program? How do you set up the people? How do you, sell this service to the right businesses in the right spaces? And how do you manage that whole process? And where do you set up those KPIs? How do you set up those KPIs? And then how do you deliver against them, right? Because, in the utility world, it's a little bit different than the commercial world. A lot of times, utilities are monopolies. And so they're regulated, by the federal and state institutions, where they're operating. And so in order to do that, there's a lot of regulatory structure that goes into development and delivery of their programs. And so typically you need a lot of kind of services to facilitate those programs, and services come down to people. And there's a lot of different, I would say, services companies that touch different parts of the utility world, different parts of the government world, different parts of commercial industries that are looking to streamline, kind of their energy production. And as we've seen energy kind of scale over the last, really only like the last 18 or 24 months, very, very significantly, these energy services and these these energy solutions are becoming more and more important, especially given, not only are, utilities trying to scale their energy production, but, commercial institutions are trying to scale their energy production. They're trying to, vertically integrate everything from energy to data centers to GPUs so that they can, facilitate the largest language models in the shortest amount of time. And so demand for energy really has never been as strong as it has been in the last kind of 24 months. And the projections over the next 25 years are very, very significant in terms of growth and energy demand. On the right, I'm showing kind of terawatt hours for growth today versus growth in 2050. And in order to facilitate all of that growth, you need, energy solutions and energy services, the same types that, you've used for the last 50 years.
To your chart, it's going to grow 50% over the next 25 years. So that's like a rate of inflation, like if you think about it per year.
50% though in terawatt hours is just an enormous amount. Because if you look at like where it grew over the last kind of 25 years, it would be like, probably in the single digits. So it's one of those things I think where you have to look at
on a per year basis. It's still not that impressive.
But like I think energy is a little different though than like revenue, for example. Like if you look at revenue growth, it's like, yeah, that's not going to be very high. But if you look at energy growth and like energy production, that's like an enormous amount of energy production. And in order to do that, you need, a ton of infrastructure that has to go into the ground and a ton of services to facilitate that. So I think it is one of those things where you have to look at maybe the bigger picture to really, appreciate and understand like how much of a tailwind this entire industry is going through. Lastly, there's competitors in every market. Obviously, there's a lot of smaller competitors here. There's a lot of smaller, services companies. It's a fragmented market by, geography and vertical. There are a couple of larger competitors. I think Sterling Infrastructure is also a public company that does more than just grid planning and energy efficiency and energy solutions. Is in a similar market though, and so they're I think around a $7 billion company, I want to say, but they have a similar type of services-led platform. So moving on to the 3 reasons, right? I always have a kind of short and sweet and dominant framework for evaluating companies.
Not the 17-point bear case.
And it always comes down to just 3 reasons. And actually, one of the things I wanted to talk about is I don't know if you guys. I'm reading this book, The Warren Buffett Way. It's like a 30-year-old book on like the education and the growth and the development of Warren Buffett. Anyway, they talk about this guy Phil Fisher, who is like responsible for like Warren Buffett's views on like buy and holding stocks. He's often described himself as like 85% Benjamin Graham and 15% Phil Fisher. So Phil Fisher wrote this book, Common Stocks and Uncommon Profits, and it was the first.
I've read that book.
It was the first investment book that was a New York Times bestseller, and he wrote it in 1958. But basically, he had this, thesis that there's 2 types of companies that would dominate decade by decade, and the first is the companies that are fortunate and able, and the second is companies that are fortunate because they are able. And so that first group of companies, that are fortunate and able are basically companies like Alcoa is his example. So, Alcoa was in the right place at the right time, right? America was growing really significantly. They needed a lot of steel, and Alcoa had been producing aluminum, yeah. And Alcoa had been producing aluminum for decades. And the other type of company that they point to is a company like DuPont, which is a company that's fortunate because it was able. They had an original product that was blasting powder, and they fared pretty well as a mining company, but they took that blasting powder and they were able to repurpose it for a million different use cases. And so it was one of those companies that was able to pivot effectively, which is I think the term of use that we now characterize most companies that do this with. But I would say that Willdan in a lot of ways falls into the first camp. This is like an overnight success that took 50 years to materialize effectively. And so in some ways they were in the right place in the right time. It is a good company. They were growing pretty steadily, I think, over time. And then this massive tailwind around data centers hit, right? And this massive tailwind around energy usage and energy production hit, and they had been selling these types of contracts to to governments and to utilities for decades. And so it isn't one of those things like you can necessarily turn on, right? If you see a market opportunity, right? This is something where you build the connectivity, with these different institutions over several decades, and they just, happen to be in some ways in the right place at the right time. But this is, like, as we've talked about on a lot of these podcasts, a white hot market. And, this is a market that will continue if you listen and read through kind of all of the companies, the hyperscalers that are talking about, what are the constraints in the market today? It's really energy. And, this is a market that will be sort of supply constrained for decades to come, similar to what even CoreWeave said, on their earnings call. And so in order to facilitate, the supply, you need companies like Willdan that are, providing the picks and shovels so that you can go into a market and build a new data center. And so I think they're really sort of one of those right place, right time company that's developed this solution over several decades and will benefit massively from this. The second piece is, this is the fair price that they're, trading at today doesn't capture the upside of the company. So I show on the far right of this chart, the EV to EBITDA is like 22 times, and the PE is around 36.
Super cheap.
So that's not cheap on an absolute basis, but if you look at how quickly they're growing, right? Like their Q2 25 versus Q2 24, their adjusted EPS was up 173%, right? Their GAAP EPS was up 200%. This is a company that's they beat their second quarter revenue estimate. The street number was 75 million, and they came in at 95 million in the second quarter. Like, this is a company that is absolutely, smoking the analyst models. And so I think there's a lot of momentum behind this type of company. And it's one of those companies that's like not well covered. it isn't something, that's going to be on the front page of the Wall Street Journal. I don't know. Maybe it might not even be on the back page of the Wall Street Journal. But it's one of those things, I think, where, this is a company that can really benefit from it. And, like, if you think about them continuing to beat PE, and you think about, like, we've talked about before, right, our, a PEG ratio is a good way of evaluating, the fairness of a PE multiple. And if you continue to beat your EPS, you're continuing to grow your EPS by triple digits, 173%, your PE is eventually going to look really, really soft relative to your growth. And I think this is one of those companies that's going to benefit from that type of, upside that the market isn't necessarily capturing in the name for a lot of reasons. One, it's a small name, so you can't, like, a lot of the larger institutional buyers wouldn't be able to buy the stock just because it doesn't hit, like, call it the $5 billion threshold. In some firms, it's like a $10 billion threshold. 2, it's not covered by Wall Street. 3, it's unsexy, 50-plus-year-old company that's selling services, right, for the most part, and not software. So it is one of those sleeper picks in a lot of ways, I think. But I think they've been able to develop, a product that's in the market now and will really benefit.
How can you get so much leverage? I mean, like, on earnings? Like, it seems like if it's a services company, it's kind of a billable hours, bodies. Like, you don't charge a bigger company
point, Gordo.
that much more.
A big piece of the leverage I think you get is from the backlog that the company takes. So they'll sign contracts that are like, $100 million, for example, and that backlog will play out over several years. And so you have, like, very sticky customers, like, the New York City government, or the New York State government, or Con Ed, or, SoCal Edison. Like, these are effectively monopolies, right? Like, all of those companies and institutions are effectively monopolies. Like, their money is very,
They're
very
monopolies,
good.
but these guys aren't. There's competition. There's lots of
There's competition, but they're signing up for these projects, right, that are multi-year projects that are super sticky, and so they'll continue to accrue the benefit of those.
Maybe you don't know this, but this is kind of a detailed question, but, like, if it's a services business, I mean, it's basically kind of a billable hours. It's an oversimplification, but, like, you have a cost, you have people. Like, how can you charge $1 bazillion for the same head at one company and $100,000 at another? Like, maybe there's
the demand dynamics in the industry right now are very, very strong. So if you look at gross margin, for example, in the last quarter, it's 5 percentage points higher than it was in the previous quarter. And
what
so,
is it,
like,
50%, 30%?
it's like 39% versus like 35 or 34.
It's starting to smell a little funny. Starting to smell a little funny. Seeing a software company, but it's interesting that they have this kind of earnings growth, that kind of margin, and it's scaling.
I mean,
it makes me wonder
if you see a 55-year-old company with 5 percentage points of, like, margin expansion in a quarter, like, the demand dynamics around that industry have just, like, fundamentally changed. I mean, I just don't think you necessarily almost ever see that.
So maybe they have pricing power because they're so unique in their services and capabilities.
Yeah, and there's so much demand right now in the market for this type of thing that people are willing to overpay.
Or I don't want to tip the bear case, but it's starting to smell a little bit, but still very impressive earnings growth. Granted. All right.
And then lastly, I'd say this is, like, as I think about it, like a ideal takeout candidate for a private equity firm. Like, there's, I can't see the number now.
They love paying high multiples.
This isn't a high multiple for a company that's growing that fast. Like, 22 times EBITDA. Like, you see companies that are growing slower than this with less scale that are being acquired for like 25 to 30 times EBITDA. They are software companies, but you don't see this level of growth. And so, like, I think it is one of those things where, like, if you can acquire this company and you can, at like a relatively okay valuation, they have a long operational history. They've been in the market acquiring companies for, the last maybe several decades, really, at this point. But it is one of those.
So it's not all organic growth, is what you're saying. So they acquire their way.
Yes, exactly. This is a company that acquires companies. That's like the model for building EBITDA, especially within the private equity context. And so I think it is one of those companies where you can start to build a very, very significant EBITDA base, both organically because there's such high demand in the market, but also, like, if you have private equity coffers behind you, you can go into the market and acquire even more aggressively. So you can take a company that's doing, call it 100 million in EBITDA, and if you double that to 200, you get massive margin or multiple expansion rather. And so this is like I think this is a company that would be ripe for an acquisition. You can turn a company, like Willdan into a company like Sterling, right? And go from 1.7 billion to 7 billion. And so it's one of those things, I think, where, a lot of private equity buyers who are seeing a lot or who have a lot of dry powder on the sidelines will look at a company like this that has a unique offering and be able to come in with a strong offer and continue the playbook that they've kind of started from day one. Maybe not day one, maybe year 35. But I think it is. I think it is one of those companies. The other piece is this isn't a company that has a supersized valuation, so the universe of potential buyers on the takeout side is much, much bigger than a company that was like a $10 billion enterprise value company. So I think you have even middle market buyers that could go up. You have obviously the large buyout firms that could come down. So it is one of those companies, I think, where you could have a lot of interest from the buyout universe and get to an early, fairly significant outcome.
How would a private equity company, and what's the profile? This is more your area. I mean, the layman, is going to think private equity is, hire and fire, it's or maybe combine with other portfolio companies to get synergy. I just don't see how you buy a really expensive company like this as a private equity guy and add value, in the darkness behind, the accountability of public markets. What's the profile?
I think the playbook for a lot of private equity firms today is to buy assets that are strong assets independently and try to scale them through acquisition very aggressively. So you get to an EBITDA base that's much, much bigger, and you're able to command a more significant multiple than the company was independently because it was just smaller. This isn't a covered company. It's not understood. If you got this company
but it already has a full valuation. The problem is the cat's out of the bag here.
I don't know if it is. I think this is a full valuation as you look at it today at the end of August. But if you look at it at the end of next August and, the EPS and the revenue and the EBITDA continue to scale significantly, it won't necessarily be considered a full valuation.
All right. I like it. This is the Rip and Winkle stock. Buy it and go to sleep under a tree. So don't look at the valuation. By the way, I love your shirt. You're quite the twink, Bruce. So let's move on to the bear case.
I wore it for George.
Pull out your claws, man. Let's rip into this thing.
All right. Let me see if it'll let me share. It's not seeming to hand it over to me.
Oh, here.
Let me try now.
You just wear that around the house for your wife, Bruce, or do you just getting done working out? What's the story there, man?
I just got done working out, and nobody's home. The kids and the wife are all gone, so I'm just.
It's for comfort, or just stare at the mirror and flex, or flex those guns.
It's for speed, not comfort.
Yeah, that makes sense.
Yeah,
so you shave your entire body.
Underneath is the question. It's just
all. Bruce shaves his entire body. It's true.
Paper.
All of it.
Oh my God.
Here's my Willdan out. So I've got apostrophe N, Willdan out, the real spelling with my brown bear there.
By the way, did anybody here know what a baculum is? Know what a baculum is? Google it.
Idea.
All right, baculum. You'll find out.
Feel like I'll get in trouble on my.
It relates to a bear's anatomy. All right, it's a special piece they have. We don't. Anyway.
All right, excellent. You're full of valuable tips on how to get fired. All right. So here's my 17-point bear thesis now. It's more like 8 points. So first one is you're riding a narrow wave, as it's said. So basically, these guys have had a diversified pool of different drivers. They have energy. They have this consulting business. They kind of track both of those. But it's really driven off of AI data center power demand, which Bruce talked about. So that's been great. The one thing I would note is their margins on the energy business is much lower. So if you look at their profit margins, it's 5%. Yes, just 5, single digit, mid, single digits there.
Just a question one quick question on the title. If this is a narrow wave, what is a wide wave? Like AI data center power demand is a narrow wave.
I'm just saying they're a one-trick pony. How about that?
Yeah,
The
that kind of
pony club.
Yeah, CoreWeave's a one-trick pony too. It's a $50 billion one-trick pony.
AI data center demand. That wasn't a great lead. Okay, let's
All right.
let
I
him
will
continue.
say this was AI, but I'm standing behind it. All right. Anyways, it doesn't diminish the point. So, anyways, of their two businesses, energy and consulting. Energy is where this falls. It's a 5% profit margin business, so you can grow it to the moon. You're only getting 5% profit margins on it. Consulting, they get 12%, so that's actually a better business. The other thing that they talked about on the call, on their most recent call, is they're getting hit for big projects with tariffs, so that's coming in on cost and equipment. So that's something that in the near term won't bite them. They're hedged, but 2026 and beyond, there's going to be some price spikes on that. So they're going to get hit by tariffs. So end of the day, like you're investing for something that's 5% profit margin here and growing on that, you're going to need huge growth to really see that hit the bottom line. And then the other thing is a lot of their business comes from utilities, state and local governments. Those are always dependent on on funding, both by ratepayer fee increases and municipal bonds. That's not something that's a given. So again, 85% of their business here, you have to be able to get those passed through. I'm sure your average consumer is not going to be excited about funding big projects by paying more for their electricity, so they can support the local AI data center. So I don't think it's going to necessarily just be up and to the right here. There's going to be some bumps that they have to go through. They also, point number 3 is they are having a big tax impact from the big, beautiful bill. So they this year are expecting a 15% credit due to 179D incentives, which I have no idea what those are, but they are getting 15% back on their taxes, even though they're profitable. And then next year, they will have that turn into a 26% or 20% tax burden is what they're expecting. So that's a 35% change on your already thin profits that you're going to get hit with. So end of the day, you can keep growing, but end of the tax man's going to come take his piece of that at a much larger rate than what they've seen historically. So that's also not a positive for these guys. Bruce mentioned dependence or they make acquisitions. They historically have done a ton of acquisitions. And if you look at their growth, a lot of it's been fueled by acquisitions. And so it's not necessarily a bad thing, but more often than not, there's very few that can do acquisitions truly in an accretive manner. Like every company you acquire, you're having to pay a premium for. And so
But isn't it always accretive if your EBITDA multiple is higher than their EBITDA multiple and you're paying for an EBITDA?
But has it been always?
It's like by definition accretive.
Yeah, but you gotta maintain that business. You can't destroy that business, right? There's often dyssynergies.
If anything, like their currency has gotten much, much stronger because companies in this space trade for 10x adjusted EBITDA.
Yeah, but these guys are overvalued, so eventually the market will see that. But in the meantime, they've got to execute on those acquisitions. And so, like, if you look at what they've paid, and historically, like, they've not been afraid to pay decent multiples. They call it Lime Energy. They paid 10 times their adjusted EBITDA for that one. And then if you look at the growth, like, the growth looks a lot less impressive when you start including or backing out the revenue they've acquired. So, for example, Lime Energy, APG, which was 2024 acquisition, or 2025, it did $37 million of revenue in 2024. So if you look at what's expected for this coming year, about 17-18% growth, you back out 3/4 of that $37 million, suddenly it's now 12% organic growth. So their organic growth is actually much lower than advertised. And so you're dependent on them continuing to be able to make and find good acquisitions to go execute on. And they've done 10 acquisitions over the last, let me see, 1, 2, 3, 4, 5, 6, 7. Yeah, like 10 acquisitions in 10 years. So you got to do at least an acquisition a year, which is not necessarily a given that that's going to happen.
I mean, well, a couple of things on that point. I think one acquisition per year is pretty reasonable for any company. I think acquiring companies as a strategy isn't necessarily a bad thing. You look at Constellation Software, for example, back out all of their acquisitions. I mean, it's like.
Wait, have they actually outperformed the market? I don't think they have. There's very few. Like I think of like what was the predecessor to now Bosch? You know, it was like a big acquisition machine, Vertex or whatever.
Constellation is like Canada's largest company.
Yeah, but they haven't outperformed the market, so people have handed them
They
capital.
outperformed the market.
There's a couple of them up there in Canada, and the majority have not outperformed. I don't think Constellation has.
I'll fact check that in the background.
Yeah, maybe you can look at that as we go. But end of the day, like, yeah, it's a skill set. I think these guys have been decent at it, but like you're depending on that. Like I would much rather have organic growth than inorganic growth, and that's coming from someone who's been close to M&A for a lot of their career. The other thing, point number 6. I really don't have 17 points. I have 8 points, but point number 6 is they have a lot of lumpy contracts like services revenue. This is not SaaS. So like an example is they had this big 5-year deal with LA Department of Water and Power. It was a $330 million deal. It continues to have long delays. They keep talking about it forever. It hasn't come to fruition. All these things are very difficult. Even when they start it, there's a lot of rules around when you can recognize revenue. So it's a very lumpy business, and lumpy businesses historically trade at discounts because you can't depend on them. You can't depend on the revenue, and it can create a lot of challenges for that business. They may have to lay off people, especially when people is their biggest cost if these deals don't come through. Point 7 is peak margins, and I have 2 7s there, but I guess it's lucky double 7. This year they do this interesting thing. They have both contracted revenue, which is kind of the headline number you often see. So that's a much larger number, and they subcontract out below that at seemingly like no margin a lot of the work, and then they actually have the work that they do themselves. So they're also handing off a lot of this work to other parties, which granted is probably, to my last point, is probably a rich, really easy pool of like companies to go acquire because you're contracting that revenue. You have customers that want those services, and you're like, hey, great, we keep pinging, Bob's energy consulting services. Let's just go acquire them. So I do think they probably have good targets. But they've targeted for their margins, like, hey, our target margin. A lot of companies will say, we have a target margin. When we get to maturity, we get to a big size, like this is our target margin. They've said their targeted margins on their net revenue is 20%. Guess what? They're hitting that this year. And so they're not necessarily saying they can go higher than that. And so, like, I like to buy companies that, are off a peak margin, especially a cyclical company like in a consulting.
You like to buy companies that lie to you more.
And you buy at a discount, and you can look at the margin cycle. Right here, you're buying at the top. This is the highest margin they've ever been. So if I go back, I have a chart here, and this is adjusted EBITDA. So they're they back out what they want here. But you go from 14.5 down to 13.5 down to 10. And then they start to get this AI boom. So in 2023, it jumps to almost 17, then 19, and then 2025, they're expecting around 20 is what they're forecasting. So this is the highest they've ever been. And to Gordo's point, like, they still look at their business like it doesn't scale. It's a per employee. It's very variable cost. And so, they are doing better than they've done historically. Like, net revenue per employee is growing, but like it shows like they're dependent on employees. And so you're never going to get the scale that you get in software. In software, you build the software, you deploy it, and you continue to get scale because people keep buying that software. It doesn't really cost you much more to deploy that software. Like, the R&D scales. Here, the R&D is like, I got to go send X number of employees for every job. It's a variable cost. There's no fixed cost to that business. And so you never get the kind of scale that you get like in a software business. And so
but the main difference there though is in a software business, like this business, if it was a pure software business, would be valued at like 5 to 7 billion. Because that's just why those businesses you're paying much more in premium.
You're already
Like,
paying a lot
like,
here. I mean, you
you're
can't
paying
look at EV to revs because that's not, your margins are so low. So on a profit basis, like, it's very high. And so that's my last point, is the premium valuation. So if I go to my comp table and I look at this, you know, you already outlined
17 points, by the way. Thank God. I was really worried when I got to the bottom of that slide that you had no more to go. Thank you.
This is the last one. And basically, I'm arguing they trade like a software business at 22 times EBITDA, 36 times. Like, I have a number of consulting names listed here. Like, no one trades in that ballpark, and they are the fastest growing. But, like, I'd point you to Bowman Consulting. They trade at a very similar growth, 16% versus 18%. Same rule of 40, and yet they're cheaper. And everybody else on here trades much cheaper. These guys have skyrocketed with this energy boom. And now, like, I think all the good news is already out. There's no upside left. They're a services business. When people realize they don't scale and they're, like a software business, like, this is going to go back down to the realm of where everybody else trades, which is like, hey, look at these.
Because you think that AI has run its course and, like, you don't think there's much room left.
At 5% net profit margin, they're really not going to see it. These guys trade on profit, do they not?
They trade on profit, but they've seen their profit, like, jump significantly on a year-over-year, quarter-over-quarter basis. They're continuing to see, like, increased demand in the market.
Because it was so low before. Their net profit was like 10 million. They had like 10 million of EBITDA. So yeah, it's a big percentage when you go from 10 to 20.
Yeah, but
like
the 5% profit margin is built into the PE multiple. Like, that's not a separate point. It's like a part of the PE multiple
is too high.
I don't think it is. Like, if you're seeing your PE grow faster than 36% on a year-over-year basis, then it's not too high.
So the market here anticipates you're going to grow at, call it 18%. So do you think the company can grow faster than 18%? And by the way, that's not all organic, so you're going to have to continue to count on them making, acquisitions.
18% is the consensus, right? That's consensus. That's not what the market's pricing in. That's consensus.
Yeah.
The stock is, by the way, tripled in a year. It's gone from 40 to 120 roughly, right, in like a year. It's a huge breakout in the last year. It was like kind of flattish for, like 4 years, and then just the chart's insane. So what did you buy it, Bruce?
Very, very recently, like after they reported the last earnings.
You're a fucking Mo. Okay, all right. Wow, that's interesting. I mean, it's okay. Continue. Sorry, I didn't mean to break up the combo, but
I think that's most of the bear points. So it's buying a premium, dependent on acquisitions, dependent on industries that aren't always steady eddy, and you don't have a scalable model here. You're dependent on human labor. So like, it doesn't get me super excited these valuation levels. If they were trading like a regular services company, sure, but that's the case for staying on the sidelines.
All right, well, we know what Bruce thinks. I don't think we need to ask you that you're actually a bull. You own it. So we can just, you don't need to hear your opinion on that for efficiency. So, George, what do you really think? Are you going to buy with Bruce and finally make some money with him again, or not?
I don't hate it. I agree. There's growth here. What I don't appreciate enough is like the difference of their service offering versus others. Because if you look at, like Bruce was saying, hey, Sterling's one of their closest competitors. Sterling's growing 1% a year, and so like what are they doing uniquely?
They're more like they have a bigger platform though that's selling to different industries, different products, different services. It's not like a true one-for-one comp, but they do sell into the same industry.
But I mean, I think overall, like, yeah, I mean, I think if this thing were valued, like, I feel like the news is truly out of the cat is out of the bag here. Like, people have seen the growth, they've jumped on it, and they've just pushed this thing too high. So I'm not like jumping up and down for a model that doesn't scale. So I don't hate it, but I think I'm going to stay on the sideline on this one, to be honest with you. So I'll call myself a hold to sell.
I'm kind of in the same boat, honestly. Like, first of all, I respect Bruce's opinion. This is an area he's kind of, I think, an expert in, and it just makes me nervous as hell. The stock is up a ton, and I'm just not convinced that the leverage is going to continue to be there. Like, that kind of earnings growth just seems unnatural given their margins and their and it's a service company. I'm just like, God. I mean, I need to do more work to get convinced that they really can sustainably just explode. I mean, that said, I'm like, sorry, George, data center, you're being a levered play on like data center energy demand. Like, holy shit. Like, that's like a screaming buy, just saying those words. But I look at the chart and I'm like, if I were still, on the sell side, like to try to pitch a stock that's tripled in a year, a services company with, margins that are pretty low, ultimately, it's just like, it makes me nervous. So at the end of the day, I can't chase it here. Like, I want to like it for the secular demand story, and it seems like they have something clearly that's unique with the margin that's growing, and they clearly have something that's better than everybody else. But there's a little bit of leverage here too. It's not a levered roll up, but there's a little bit of leverage. And there's a lot of acquisitions. So can they keep doing that? I don't know. So I guess I'm going to be a somewhat hesitant, sell. On this, but in a very light one, because I just can't. If the stock gets blown up, I think that'd be kind of like, go down 30% or something. Like, I just can't buy this chart. I hate to be a chartist, but so anyway, I guess the pot officially is 2-1, but that's okay, Bruce. We've been wrong before.
Knocked.
I'm sure that everyone's going to race to listen to this pod, that $1.7 billion kind of energy-ish name, but it's always good to cover a hidden gem. So anyway, let's wrap this up. As we always say, bulls make money, bears make money, pigs get everybody. Pigs get slaughtered.
Oink oink. We out.
You got a pretty mouth. Bye bye.
Make money, money, make money, money, money. Money makes the world go round. I'm the talk around town. Remy gave me the sound. I need that Skrilla on the Rilla. I need that